the Securities and Exchange Board of India, SEBI, that has tightened the regulatory framework for SME IPOs to protect investor interests. Now, it will now allow only those entities that have an operating profit in at least 2 of the previous 3 years. In fact, companies will be barred from raising funds to repay loans to promoter entities. There will be a review of merchant banker regulations as well. It also mandates that shareholders cannot sell more than 50% of their holdings. SME IPOs, remember, are an essential platform for small and medium enterprises to raise funds, reducing the dependence on traditional bank financing. This is also driven to enable financial inclusion. But remember, these changes have been brought in after the SME IPO segment in particular has been under the regulatory scanner for quite some time now for the overly optimistic portrayals of financials and valuations, which actually has led to many a times in the past price inflation. But the question is, how significant are these directions from SEBI, and will they give the much needed circle of protection to investors? And to discuss that and more, now joined by Sriram Subramanian, founder and MD in Govern, and HP Ranina, lawyer of Supreme Court. Thank you very much, gentlemen, for joining us here on ET Now. Let me come to you first, Mr. Subramanian. The SME sector, like I was saying, has been under the regulator scanner for quite some time, given the access to capital. And we've seen several of these IPOs which have raised eyebrows and have gained bumper returns. Now, with these tightened rules that SEBI has announced, how were these companies, some of these companies, misusing the gaps that were there in, of course, the release of these IPOs, and how were they really putting investor interest in jeopardy? We'll come to the rules in just a bit, but let's address the problem first.
Yeah, good evening. Definitely there is a frothy market out there. If you see the amount raised in calendar year 2024, almost 8,200 crores has been raised by 239 SME IPOs. So what SEBI is trying to do is basically put the onus on the companies and the merchant bankers to some extent to protect the interests of the investors. Two is, obviously, there are bad actors. Even recently, SEBI has asked one SME IPO company to return back the funding raised during the IPO. So there will be bad actors. And not all IPOs are listed bumper listing. Out of the data that I saw, 239 IPOs this year, 165 have listed with a gain. The remaining 60 odd have listed with a loss for investors. Definitely investors are, I would think, for the listing gains, and subsequently got to see how this pans out once these regulations are put in place.
Right. Let me come to you, Mr. Ranina. Now, I have some details of some of these IPOs actually, which have gained quite significantly. In fact, one of the companies has gained over 700% in returns. One of them has gained 50% in returns. The others also have around similar numbers. But how much do you think, what kind of a relief do you think investors will get, with respect to these new rules? Will it make tougher now for companies wanting to IPO?
No, I think the main object of these guidelines is to protect the interest of investors. You see, whether IPO are ultimately profitable, successful or not is a different issue. The idea is that the money should not be utilized for repaying the loans taken by promoters in the past. The main issue is that the money should be used for the purpose of the business and should not be siphoned out for any other purpose. So that is the whole objective of this guideline of SEBI, to protect the interests of investors. Ultimately, some may succeed, some may fail. That's a separate issue altogether, because the investor takes it as his own risk. But so long as the investor is protected, which is really the obligation of SEBI, I think that the situation is well under control. So I personally feel that these guidelines issued are in the public interest. They are good, and they need to be respected. And I don't think it is going to affect any MSME to come out with an IPO. In fact, it will strengthen their hands, because investors will now feel more confident in putting the money into the IPO.
Right, Mr. Ranina, let me take that question to you, Mr. Subramanian. Of course, this has been a perennial issue and an issue that SEBI has consistently spoken about earlier in the past as well. In fact, there have been some guidelines as well that were issued. So I'll ask you that question as well that I asked Mr. Ranina. How much of a relief do you think investors will get with respect to these directions that have now been issued? In fact, there is a whole list of these directions, for instance, allowing entities that have an operating profit in at least 2 of the previous 3 years. There is promoter lock-in percentage as well. And of course, it also mentions that there will be no IPOs for repaying promoter group loans. Help us understand the kind of relief that investors will finally get as a result of these new stricter norms and guidelines.
I don't think SEBI's outlook, as Mr. Ranina said, was the investors' relief. Investors are hunky-dory now. But the fact is that bad actors may enter the market, and that is what SEBI is trying to protect now. The investors from the companies, bad actors, bad companies, bad promoters entering the market and trying to rig the markets or anything. So to that extent, one is usage of funds itself. Only about 15% of funds can be used for general corporate purposes. And 85% minimum 85 has to be used for specific projects. So to that extent, the onus will be on merchant bankers and the company to use the funds for specific project related purposes. In the past, SEBI has fined those companies or asked the companies to refund the funds raised if it is not used for the proceeds it was intended for. Two is it cannot be used to repay the promoters. Three is the lock-in of the promoters is now spread out over 2 years. They cannot sell immediately after listing or after a few months after listing. They have to, their lock-in is much more spread out over 2 years now. So all these, this one is to ensure that only good companies come to the SME IPO and raise capital. So to that extent, the filtering mechanism for companies to enter the SME IPO market has become much more stricter so that only good companies come. There is definitely capital out there. Investors are keen to invest, and given the oversubscription numbers, of course, appetite is very high. There is no, I don't think there is any slowdown or any signs of slowdown at all. 2025, of course, opens again. I think there will be a slew of IPOs at the beginning of 2025, but this at least acts as a gate for good companies to come in.
I'll ask you one more question on the point that you raised, and then I'll come to you, Mr. Ranina. When you say that there's not going to be any slowdown, is that a short-term perspective or a long-term perspective? And what do you really anticipate for 2025 in terms of IPO activity? Because we've seen bullishness over the past couple of months, in fact, years.
Out there, there is no signs of slowdown, especially in the IPO market. There is going to be, right from the main board to the SME market, there is going to be a further flood. And I would think 2025 will be bigger than even 2024.
Okay, and let me come to you, Mr. Ranina. I mean, you know, there is a view, we've spoken to other market experts, they say that some of these could then be applied to main board IPOs as well. Is that needed?
No, I think this is earmarked for the MSME sector, because this is a sector which is just growing, and investors have to be a little wary about this, because these are all closely held companies, family-owned companies. So I don't think these guidelines are likely to be extended to others. They're specifically designed to protect the investors when they go for IPOs which are issued by micro, small, medium enterprises.
All right, sir. And in fact, there is also a view, Mr. Ranina, that some of these restrictions or some of these norms are quite excessive. Would you agree with that?
No, I would not agree with that. I think these are necessary in the interest of the investing public. And I think SEBI has been quite perspective in making sure that they are not overboard. So I don't think these guidelines need to be diluted in any way. I think they will be done maybe after 2 or 3 years. They will review those guidelines. But currently, I think the guidelines are well placed.
Okay, Mr. Subramanian, let me ask you about one specific point from these, these guidelines that have been tightened, that shareholders cannot sell more than 50% of their holding. What's the biggest benefit that you expect for investors?
No, this is the promoters may not sell more than 50% within a year. So to that extent, the liquidity in the marketplace may be slightly lesser, because otherwise promoters would be one more provider of liquidity, selling shares. So yes, definitely that at least ensures that promoters are here not seeking short-term profits. They are here for longer term. To that extent, good companies come. And adding to Mr. Ranina's point, see, at the other end, out of the 230 SME IPOs that have come, if you see, there is a concentration. Almost 90 plus IPOs are from Maharashtra, 60 are from Delhi, about 70 are from Gujarat. So there is a risk in that sense that promoters and brokers may try to rig the market and try to make use of this excess liquidity and appetite for SME IPOs. And that's the reason the SEBI's outlook is to ensure that good companies come and the fly-by-night operators are sort of held in check.
Absolutely, Mr. Subramanian, that essentially is what the key ask of investors really has been. And of course, that is the key intent of SEBI, is to protect investor interest so that only good companies come forth and, of course, create a wealth. There is wealth creation, and of course, all the bad apples are weeded out. On that note, thank you very much, Mr. Ranina and Mr. Subramanian, for joining us and sharing your thoughts with us right here on SME IPOs and, of course, SEBI's new guidelines with respect to this sector. Ladies and gentlemen, there is much more to be discussed in terms of whether these guidelines are enough to fill the gaps, or is there more ground to be covered. Of course, we will be doing that another day, but for now, it's time for us to slip into a quick break as my co-anchor Ankita Saxena is taking the show forward. On the other side, she will be discussing and she will be taking a look at Accenture's Q1 report card. Has the company delivered on analysts' expectations? Details coming up with Ankita Saxena on the other side.